Hello, this is George Demaree with another episode of Your Money Matters. Tell you what we're going to do today. We're going to do something a little different today. We're going to talk about financial terms that you need to know in order to truly be financially literate. So when you hear these terms, that you know exactly what people are talking about, and there's so many. I mean, there are literally tons of terms. But I chose the ones that you've probably heard the most, or the ones that I think you really need to understand the most today. Probably in episodes to come, we even do some additional terms. But today, what we're going to start with. Hope everybody's doing fine. Today we're going to start with a term that you hear all the time because of the economy. How often have you heard this term on the news? It's going to be a recession. People predicting recession. Some people have even gone as far as to say that we are in recession. So, but what does that really mean? I mean, what if a person says that we're in a recession, what needs to happen in order for our country to be in recession? Sometimes I'll say this. You have to be cautious of where you get your information, whether it be a conservative media or more liberal media. You still have to do your own research to make sure that you understand what they're saying and if it makes sense. Well, let me tell you what recession really is. Recession is a period of economic decline of our GDP, our gross domestic product, over 2 consecutive quarters. So this is my thought. How can you predict a recession if we haven't had at least 1 quarter of negative GDP? If it requires 2 quarters of GDP to officially be in recession. And let me also share this about that. In the 4th quarter this year, our economy grew 2.9%. So our gross domestic product grew 2.9%, 4th quarter 22, and up 2.1% for the entire year. So just based on definition, we're not in recession, all right? Now, let's talk about the meaning of GDP. GDP is the total value of goods produced and services provided over a specific period. So it's the total value of what we produce as a country and services we provide, and all of last year, if you put it all in a bucket, it grew 2.1%. Let's talk about the U.S. GDP. It's pretty interesting information. And always remember this information that I have, you can find out for yourself. I find that, when I'm doing research for these kinds of episodes, I found it to be pretty daggone interesting because it makes all of us a little smarter. The U.S. GDP in 2022 was almost $21 trillion. That's large. Ranked first in the world. China is second with almost 15 trillion, and third is a distant third, that's Japan, at 5 trillion. So the United States of America is by far the richest country in the world. We're going to talk about that a little further too. It's good to know this. Let me give you this bit of information. In comparison, do you know that Russia's GDP is over 1.3 trillion? So you have the US GDP at almost 21 trillion. You got the Russian GDP at 1.3 trillion. Let me tell you what, they are nowhere close to where we are as a country. Now, let's also talk about the next term is consumer buying power. When they say consumer buying power, what do they mean? It represents his or her, our population's ability to make a purchase. Has nothing to do with wealth, because it has to do with your ability to make a purchase, which not only includes the cash that you have on hand, but also your available credit. It's purchasing power. Next, let's talk about black buying power. It's pretty incredible what I'm about to share with you guys. The buying power of black people in America grew to $1.6 trillion in 2022. Yet, the black net wealth declined 14%, according to a CNBC report on black buying power. If you would take the black buying power of black people in this country, and if that were GDP, we would be ranked in the top 11 or 12th in the world in GDP. Because remember, I just shared earlier that Russia's GDP for the year was 1.3 trillion, but yet black buying power in America is 1.6 trillion. What do you think could happen if we all got together? If we all did business with we took at least an opportunity to do business with people who look like us, all right? Who, if we could circulate our money among us, and I bet amongst our group, I bet you that our wealth would not have declined 14%, but it would be in a point of accelerating. Next term, GDP per capita. That is the sum of the gross value per person, so in a geographic area. So if that's per person, no matter what. So you take the total GDP, which is almost 21 trillion, you pretty much divide that mathematically among the over 330 million people who live in America, and it gives you your per capita GDP. Now, in the world, America per capita is 13th. But let me tell you what that is. Do you realize that per capita our GDP is about $76,000 a person? When I looked that up and saw it a couple of days ago, I thought that I was amazed by that. So if you took all the money that we produce, goods and services, and you spread that among everybody on whether it be whoever it would be, that would be $76,000 per person. We are a very wealthy country, but all the wealth, the great majority of the wealth is on the top end. That's why it's important that our church wanted to have programs like this in order for our members and friends and viewers of this program to have some sense of what it takes in order to be financially literate. It is important that we focus on health, because we want to stay healthy, wealth, how can we put ourselves in a position to live a productive life and have an opportunity to give back to people who are not as fortunate, and also how to build relationships. That's what we try to do. Next term, the S&P 500, the Standard & Poor's. Well, and let me tell you what that is. And when you see it on the news and they talk about the Standard & Poor's and what that index is and what it really means, it is a group of about 500 of our country's largest businesses and corporations. It's made up of companies like GE, Microsoft, Citigroup, Exxon, Amazon, and Alphabet, just to name a few. So they put this approximately 500 businesses collectively in a group, and how are they doing as far as returns is valued to stockholders based on their projections as compared to everybody else. Usually, that index, and remember what the index is something compared to the norm, usually over the course of time, the S&P 500 has grown at about 10% a year. So for long term, for those of you who are just beginning to invest or maybe have invested but still have a number of years left, if you invest in the S&P 500, that's the Standard & Poor's 500, and you do it over any length of time, you would average about 10% of growth on your money on that. Now, that does not mean that on occasion you're going to take a dip. In 2022, we had a pretty big dip. But over time, you average 10%. So when I saw that, I said, it's a company, is an index, a leading index provider, and is a data source for independent credit rating. Well, let me tell you what it means. When I saw it, I said, well, where's it come from? What's it mean? The name comes from a 1941 merge of two financial data publications. One was Henry von Poor's, a publication on railroad prices dating back to 1860, and the other was the Standard Statistic Bureau, founded in 1906. Now, when I saw the dates, I said, well, this merger happened during World War II. So we have all this going on in our country, but yet a merger happens with these people right in the heart of World War II. And that company was founded prior to the Civil War. The Civil War didn't start to 1861. They were a company dating back to 1860. So they've been dealing with money and how this thing works for a long time. We're way behind, but we're going to try our best to help you to catch up. Next, I want to talk about ETFs. I personally like ETFs a little better than mutual funds, and I'll tell you that both can be very profitable, but let me tell you why I like ETFs. An ETF, by definition, is an exchange trade fund. It's a basket of securities that trade on an exchange, where prices can fluctuate during the day a lot like stocks do compared to what happens with mutual funds. An ETF can be traded all day like stocks, and prices can fluctuate, whereas but mutual funds, prices only change after the market closes, and it's once a day. All right? ETFs, again, are traded like stocks. They contain all kinds of investments, from stocks, commodities, bonds, and usually at a lower cost than mutual funds. The reason the mutual funds, on occasion, are a wee bit more expensive because the people who manage mutual funds, they get paid. Many times, ETFs are based on an index that doesn't require the same kind of meticulous management, which makes them a wee bit cheaper than a mutual fund, all right? Commodities. Well, when I saw that commodities could also be a part of ETFs, I thought I would take a couple of minutes to share with you what a commodity is. Commodity is raw material or agricultural product that can be bought and sold, like copper, silver, gold, coffee, wheat, cattle. You know, when in that movie, Trading Places, it was commodities that they were selling that sent some of those guys to the poorhouse but sent the other guys to be rich. When he said, looking good, Billy Ray, feeling good, Lewis, it's because they were trading commodities. Moving on. ROI, return on investment. That's if when someone says this is a possible ROI, this is a possible return on investment. Risk tolerance. Risk tolerance is big. How much are you willing to risk? How much of your income and your assets you're willing to risk? Usually the bigger the risk, the bigger return. But are you really willing to risk this? I was talking to a person who had been who'd been an educator for years and years, but never invested anything in the stock market. He's done well, but he didn't have any risk tolerance at all. Many times what financial advisors will tell you that based on your age is what you should risk. Tell you what that means. That if you're in your 30s, if you're 30, then it's okay to risk to have 70% of what you have in a more risky stock portfolio. Then and the other 30% to be in a more conservative portfolio. If you're 70, to have because you're at retirement age, to have over 70% of what you have in a more conservative fund, and only risk of maybe 20 to 30%. Risk that 30 to 20%, but risk it in a way. I'm going to suggest blue chip stocks. There are certain stocks that even if they take a dip, the company's not going anywhere. Company just ain't going. I mean, you got companies like Coke. Coke's not going anywhere. You're not going to get a big return on investment, but you're probably not going to lose your investments. Company like Procter & Gamble. Procter & Gamble is just a great company. Some of these companies they call stables. Tell you what I mean when I say stables. A stable is a company where the products that if the economy is good or bad, people still got to buy them. Those kind of businesses. Again, usually those are what they call value kinds of stocks. They don't deliver a whole bunch of return, but yet they do give return. Many times they give a dividend. I didn't have that term this time. Maybe we'll talk about dividends on another occasion. But let me move on because I got something very more important I want to share with you. Interest rates. The cost of borrowing money. And there are many ways interest is calculated. You have simple interest rates, you have compound interest rates. Interest rates on credit cards, they're based on the APR, the annual percentage rate. They usually don't start calculating interest until after the first month on the cycle. Then it's calculated daily based on the average percentage rate. What you pay will depend on the balance you carry and whether the company compounds interest daily or monthly. It's paying interest on interest. That is how credit card companies are getting paid, because they charge you interest and then they will charge you interest on the interest they charge you. I'm going to spend a little time on that before the end of the day. Let me move on. Let me give you an example of compounding compounding interest. If you have a daily balance, if your daily balance was over $1,000 for an entire year, and the bank charged 18% just at the end of the year, if they only did it just at the end of the year, then you'd pay $180 in interest. But if it's compounded, sometimes daily, sometimes monthly, then you pay approximately $195. It is incredible how compounding interest hurts you, and I'm going to share with you later on how compounding interest helps. If you put $1,000 on a credit card while Christmas shopping at 18.9%, your minimum payment at 4% of principal, And minimum payments are usually between 2 and 4%, but on average about 4% of principal. It would take you 71 months to pay off that total, and you would end up paying over $1,500 on that money. So though the interest rate is 17.9%, what you end up paying back is over 50% of what you borrowed because of compound interest. That's why it's real important to get out of credit card debt and how these big companies are making money on you. At 30%, I'm going to tell you reasons I use those two percentages. At 30%, it would take you 104 months, and you would actually pay over double what you borrowed. The 17.9%, I have a couple of credit cards. And my credit cards, I make sure I pay them off every month so I don't pay interest on those credit cards. I looked at a credit card that I had back that I opened in 2005. My credit rating is well over 800, and yet my interest rate on that credit card was 17.9%. Wow, I couldn't believe it. Give you another one. I went to Macy's to buy some Christmas items. They said, well, we'll give you 30% if you use a Macy's credit, if you open a Macy's credit. I said, what the heck? Took me 10 minutes, opened up the credit. I got my 30%. I paid for it. I got my bill about a week or two ago. And I looked, the interest rate was 30%. If you happen to open any credit card on a retailer, those interest rates are crazy. Make sure you pay them off in time. Now let's spend a little time and remember how interest rates are determined. Interest rates are determined by the Federal Reserve. Usually they rise them to control inflation, is what's going on now. Also determined by risk. The lower the risk, the lower the rate. That's why it's important to have a credit rating over 700, because when you borrow money, you're a person who's exhibited the fact that you will pay people. So you're not as risky. The lower the risk, the lower the payment. Usually a 30-year mortgage, for an example, is a higher interest rate than a 15-year mortgage because of the length of the loan. All right? APY, average percentage yield. This is where compound interest helps you. If you're saving money, you put 10%. If you have $10,000 at 10%, which is a heck of an interest rate, all right? But I'm using that for the math. Over a year, that first year you have $11,000. Over 2 years, 12.1, and over 3, 13. Last, we're going to finish with this, and we're going to do it quickly. Amortization. I say that pretty well, right? Wish I had some help on that. All right. The amount of the principal and interest paid each month over the course of the loan. Most of those payments, when they do, you pay interest on it, or most of it's interest early and over time. So it's spread out with the same payment every month, but it's amortized. Conforming loans. Usually a conforming loan is a loan that meets the requirements of Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac are government-backed mortgage loans. And then finally, conventional mortgage loans that are not backed by government, but usually require a little better credit rating and bigger down payments. Well, and we have a few more before we get out of here. Annuities. Annuities is something that's issued by an insurance company designed to provide retirement income. Usually you get a low yield. The return's not very high, but also the risk is very, very low. When people do annuities, they do it for retirement income. I suggest to do a combination. We're going to talk about, at the bottom it talks about asset allocation, where you put some of your money in annuity, where it's saved, and then you put some of your money in the stock market, where you maybe a little more risky stocks, and then put some of your money in the stock market, where there's more value stocks, and it gives you a more rounded portfolio. 529 plans. are savings plans for your children to help them to go to college. I got a 529 plan for all three of my grandchildren. What makes them really good is when they, not only does this money grow with interest, but when they use it, they don't have to pay taxes on it if they use it for education. Capital gains is the increase in value of an asset or an investment above what you paid for it. If you sell it for less than what you paid, for less than the cost, then it's a capital loss. And finally, we'll talk about this again, is asset allocation. Refers to how you choose to spread your money across different investments, whether it be stocks, bonds, cash, annuities, and there's a variety of ways to do it. Now, there are a ton more terms, but I hope these terms helped. These are terms that everybody needs to know in order to be financially literate. Hope it helps. Have a good day, and remember, at St. Stephen Baptist Church, we're looking for you to have great health, great wealth, great relationships, and as always, God loves you, and so do we. Have a good day.